I'm in a situation where I can either stop doing business and not buy real estate and sit on the sidelines, or I can find a way to protect myself from the downside and do deals. Just a brief episode on how the market's changing, how I'm thinking about risk, debt, and my acquisition strategy. Because one of the things that I took away from the conference that I went to, and one of the questions that I had for a lot of very successful investors of all kinds was, how are you doing business in this market? What do you make of the drastic difference in the economic environment that we're operating in now and a year ago? And in real estate, that's clear. I mean, multifamily may have went through this 3 years ago, but my business is self-storage facilities are trading at 100 basis points more expensive from a cap rate perspective than they were 6-12 months ago. The appetite for self-storage is off the charts. The public REITs are dominating. Their returns are phenomenal. Bank appetite has never been stronger. Investor appetite has never been stronger. Everybody wants to own storage, so they're getting more expensive. So on my end, I'm saying, how the hell can I compete? 19 out of 20 offers we send get rejected. People are bidding more than us. I still think we have a competitive advantage in the amount that we can drive revenue and the cut costs and so on. But I'm trying to stay disciplined, and I'm trying to figure out, which most of these wealthy, successful people told me, Nick, we have to find a way to do business in any market. You have to find your way to do business in any market. How are you going to do business in this market? And we have kind of already made that decision that we are going to do a couple things. Number one, we're going to reduce debt and raise more equity. That might not be what you want to hear. And this is a double-edged sword, because the things that I do to yield is already compressed. I mean, straight up, we reached out to our LPs and said, hey, we're operating in a different economic environment. The 10% cash on cash deals, 12% cash on cash deals that we were showing you a year and a half ago, or a year ago, or even 6 months ago, they don't exist right now. At least they're really hard to find, few and far between when we do. Look, this is the economic environment. Yields are lower. Cash on cash will be 6 to 8%. I mean, we're still confident in the long-term tailwinds of our business. We're still confident in long-term appreciation. We're doing some things to reduce risk, but the cash on cash yield is going to be smaller. And if you're not okay with that, that's fine. Self-storage is not for you right now, because we can't deploy capital in any other way. But the yield wasn't necessarily compressed that much. It was compressed slightly from maybe 10 to 8.5% cash on cash. But what we did was we decided that we're going to raise more equity and use less leverage. Less leverage did two things. It increased our debt yield, meaning for every dollar of debt, we had a higher yield of net operating income to cover it. That covered our risk. A debt yield north of 10% is what I like. Every $1 of debt yields 10%, 10 cents of NOI to cover that debt. That's great. Over 10% means that I can withstand a 7.5% interest rate before my deal goes cash flow sour, if, of course, the revenue and the operations are still in place. So less debt means higher debt yield, but also less debt means more equity, means I'm raising more cash, and it means that my returns are less juicy for my LPs. So instead of debt financing 75, 80%, I'm debt financing 60%. So I need to raise more cash. The cash on cash takes another hit, goes down a little bit more. Kind of a bummer, right? The only good thing is that we get better debt terms from our bank. Our bankers are more confident in our projects when we have less debt and less risk. They'll offer us interest only for 2 years instead of 1 year. Our rates maybe drop from 3.9 to 3.7% that we're borrowing at. So 3.7% interest only for 2 years on a new storage deal. That's good. That gives us some time to let the business work and do some other things. But that's what we have decided to do that, reduces risk for us. How can we find a way to do business in this environment? It's reduce risk. It's find a way to deploy capital for LPs that view this as a wise investment in this market. We still like the tailwinds behind self-storage. We are still deploying capital. We are still buying storage. We are still operating very efficiently and letting our business work its magic over time. But that's tough, right? Raising more equity is not maybe what you want to hear. To buy $30 million worth of storage, we thought we'd need, $7-8 million. Now we're going to need $10, $12, $15 million, because after closing costs and everything else, CapEx, operating budgets, all the other transactional costs of buying real estate, it's a little bit more complex. So here we are. I'm in a situation where I can either stop doing business and not buy real estate and sit on the sidelines, or I can find a way to protect myself from the downside, hedge my risk, find partners that still like my asset class enough to invest and do deals. And we have elected to still do deals, but it's not easy. Those are some of the things that I'm doing so that I can do business in any environment. Juniper Square, the sponsor of our show, recently did a capital raising survey. And in this survey, they asked 142 senior executives at US-based commercial real estate firms a series of questions to understand the state of commercial real estate fundraising. It's an insanely valuable report with data on questions like, how much capital did you raise last year? How long did your last raise take? What type of investors are you raising the most from? And what strategies are working the best for you to find new investors? Download this report for free at junipersquareresearch.com. That's junipersquareresearch.com. Big thank you to Juniper Square for sponsoring the show. Thank you for listening to the Nick Huber Show. Just wanted to remind you that we have a paid real estate community where some really special stuff is happening. People are breaking down deals, people are networking, people are, I think, even formulating partnerships inside this group. We have over 100 members now. For more information, you can visit sweatystartup.com/REC. And the first 299 members of the group to get some momentum get $200 off the annual membership using the code FIRST299, FIRST 299. And also, you can check it out for 5 days for $1. You make a $1 payment, you can check out the community for 5 days. Highly recommend it if you're serious about bringing in some other people into your network, into your life, to help you become a better real estate investor.